All right, welcome everyone to Decarbonize Your Money. I'm Winona Bateman. I'm with Families for a Livable Climate, and we're super excited to be running this event again tonight. This is our fourth Decarbonize Your Money, and I think to date, Keith, do you want to bring us up to speed? How much money have you divested just yourself? I think last time it was $1.5 million.
Yep, it's between 3 and 4 million right now. It's closer
Wow.
to yeah.
Yeah, that's super exciting. And certainly there are other folks who take money out of fossil fuels as well, but that's Keith's work so far. So thanks, Keith. So welcome everyone. We will get started in just a couple minutes with our guests. Tonight's event is focusing on moving your personal investments out of fossil fuels. And we are very thankful to our panelists who are contributing their time and expertise tonight to the discussion. Keith Fitchner, who is a financial advisor with Edward Jones, and Whitney Sweeney, who is an investment director with Schroders, specifically in the area of sustainability. They're going to be joining us and giving short presentations tonight and then taking questions. So we are recording the event, and next week we will send a follow-up document with resources and links. And if you have any questions that we don't get to tonight, we will try to answer those in the follow-up. Tonight, many of us are joining this conversation from tribal homelands in North America in what is now commonly known as Montana. And at Families for a Livable Climate, we recognize that we cannot address the climate crisis without Indigenous leadership. Tonight, while you're thinking about pulling your money out of fossil fuels, we would also like you to think about investing money in your community and your state, and supporting climate justice efforts and Indigenous leadership by supporting groups like organizations such as All Nations Health Center, National Indigenous Women's Resource Center, People's Food Sovereignty Program, Western Native Voice, and Indigenous Environmental Network. So as we're going tonight, please feel free to type questions into the chat, and we will kind of collect them. And after each speaker, we'll have a time for questions, and then we'll also have a little more time for questions and answers at the end. So without further ado, I would like to introduce Whitney Sweeney, who is an investment director focused on sustainability at Schroders, which involves representing Schroders' sustainability capabilities across the Americas. Her responsibilities include strategy, product management, client and market outreach, and ESG integration. And as I understand it, Whitney, you are going to take an institutional kind of perspective this evening and kind of give us a context for what divestment or ESG investing looks like. So over to you.
Great, thank you very much. I'm going to share my screen. If you can just bear with me for a second. And hopefully, can you all see where it says decarbonizing your portfolio? Okay, great. So first, thank you very much for the opportunity to speak here with everyone tonight. I thought it would be a good idea just to give a sense of who Schroders is and kind of why we are on the call tonight. And as I listen to you and what your objectives are, I am conscious that I'm going to talk about engagement and not always divesting. So I'm ready for questions, but I also think it's important when we talk about what asset owners are doing, and it does vary, certainly in terms of how they choose to get to the path or their target and their goal of decarbonizing their portfolio. But first, from a Schroders perspective, we are a global asset manager, and we run just under $1 trillion in assets under management, fixed income, equities, alternatives, multi-asset. And sustainable investing is really a core part of our DNA. At a base level, all of the assets that we manage are ESG integrated. What that means is that we take into consideration the financial, material risks that are associated with environmental, social, and governance factors. And we also use them to identify opportunities. We're a global firm headquartered in the UK. So as you can appreciate, we've been talking a lot about these issues, perhaps longer than they have been issues here in the US. And we've been investing sustainably for over 20 years. We hired our first sustainability analyst in 1998. We launched our first strategy, Global Climate Change, more than a decade ago. And the reason I'm kind of highlighting some of these things is because in the world of greenwashing, questions around what sustainability is, it's important to provide some context as to our experience in sustainability and how we've partnered with asset owners and investors. So as we kind of highlighted at the beginning of the call, I'm going to talk a little bit more about how asset owners are decarbonizing their portfolios, and then lessons that individual investors can take from that as they think about their own portfolios. So again, okay, here we go. There we go. What I want to do is lay out a few basic definitions, and many of you in the call may already be familiar with these, but in case you're not, they're important foundation as we talk about a decarbonization of your portfolio. So conventional carbon analysis is focusing on emissions as a problem and a risk to be addressed, especially greenhouse gases that companies are emitting through their activities, and they're broken into 3 types. So directly scope 1. Scope 1 are those direct emissions within a company's organizational boundary from sources that the company owns or controls. So you should be thinking about things like company cars, combustion of fuel in a company plant. It's very easy to identify the source. The second are scope 2 emissions. These are the indirect emissions from purchased or acquired electricity, steam, heat, and cooling. Scope 3, this is a little bit more difficult, and you'll hear probably a lot about scope 3 as we talk, and if you're very interested in the space, these are all of the other indirect emissions, business travel, deliveries. These are indirect emissions that are occurring in a company's value chain. Scope 3 are much harder to attribute to a company. This will come into play as we talk a little bit more about portfolio implications. So if we think about sort of all of the different greenhouse gases that are emitted all along the company's supply chain, the use of their product, it's really they're larger than scope 1 and 2, and they're really key to helping a company understand if their business model is compatible with targeting the goals of the Paris Agreement. So those are the 3 that we will talk about. There is also scope 4, scope 4, avoided emissions. And essentially avoided emissions is anything that is saved indirectly by products or services to substituting high carbon activities with low carbon activities. So if you were to think about wind power, so in order, like the greater good is that you're going to be having emissions that are better. They are, this particular company, in this instance, a wind turbine, they are contributing to a better good because they're substituting more carbon intensive gas power generation, but they have to actually contribute fossil fuels or emissions in order to be able to do that. But it's something that we have actually started to measure in some of the work that we've done. And it's very important when we identify what are, quote unquote, good companies versus bad companies. So when we think about net zero or decarbonization, and I talked a little bit about asset owners trying to reach a target. Net zero is a target, decarbonization is the path that you get there. So when you think about the implications for your portfolio, there are several approaches that you can take. The first is setting financed emissions constraints at a portfolio level. This is met through divestment. So divestment of more carbon intensive issues within the portfolio. So congratulations to Keith, who has actually kind of made some progress on that path. And I'm sure many of you on the call as well. If you have a carbon intensity target, you can, as an asset owner, set a portfolio constraint without changing the mandate. You could simply say to an asset manager like Schroders, I'd like to commit 20% emission reduction by 2030. How do I do this within the constraints of my existing mandate? You can think about investing in low carbon alternatives in a particular sector. You could reweight your portfolio within a particular constraint. And this would allow a specific amount of emissions to be reduced in terms of low-hanging fruit, not requiring a full portfolio reallocation. That's the next stage. There's really only so much that you can pull in this first level, because as your target becomes more aggressive, you have to think about changing your strategic approach. And that brings us to the second option, which is reallocating your portfolio. So you're moving from more carbon intensive portfolio strategies to those that are less intensive, or having a higher allocation to low carbon sectors. And it's important to recognize for asset owners that there are implications to doing that. So if we think about that, kind of looking at sector or regional biases that carbon intensity can have, typically emerging market funds tend to be more carbon intensive than developed market funds. If that's the case, you have to think about, do I want to change the regional structure of my portfolio? You could also be looking at it from a sector basis. So those funds that are more focused on low carbon sectors, so say technology, retail, or insurance. So you'd have to think about, do I want to tilt my portfolio to those sectors rather than investing in materials or utilities? So this is just something that you need to think about on how aggressive that route to decarbonization wants to be. And I'll show you a chart in just a minute that kind of brings to life what that means from a portfolio integrity standpoint. Now, the third is target based. This is based on what target the companies in your portfolio have set. And I'm not saying all companies haven't set targets. I think that's important. And we track and we measure this in terms of understanding where companies themselves are on that path. But if you're looking for a forward-looking approach, this is less about portfolio reallocation. It's more about setting an engagement strategy for getting the companies that you're invested in to set targets. And this is where a strong engagement plan, a climate transition action plan becomes very important. So as we think about that closer look at implicating or excluding sectors, so whether you're using portfolio constraints, you're reallocating, what does this mean? So when you look at this chart, you can see that 5 sectors account for the bulk of scope 1 and 2 emissions. And I don't think this is going to be surprising to anyone when you look at what those sectors are. And what this would suggest is that if you divest from these sectors, it'd be a good thing. But having such a granular view of the underlying assets in the investable universe is very beneficial, because if you take the approach of just divesting from entire sectors based on their overall emissions, that can have a significant impact at the portfolio level. So there are 2 implications. The first is the diversification of the portfolio I just noted. Second, divesting just puts those assets in the hands of less climate concerned investors who would be willing to own them, despite what their emission profile looks like. So while divestment from entire sectors is an easy way to reach net zero quickly, it's unlikely to solve the problem of getting less green companies to improve. So it might help a portfolio reach net zero. It does nothing for the planet because divested assets continue to function. On the other hand, divestment also potentially misses some opportunistic investment discrepancies between companies within a given sector. Instead, from our perspective, we believe that owning and engaging with companies in these sectors is likely the more effective decarbonization strategy. When you set a decarbonization strategy, there's a trade-off between the physical and the transition costs of climate change and the investment integrity of the portfolio. So if you think about the target or the chart that we just saw and that size of the universe, if we were to, and when we look at this chart, what you're seeing is the blue line down the middle is that 1.5 degree consistent linear trajectory. And the chart to the bottom of it, the green line, is essentially a more aggressive decarbonization strategy. So I'm going to do this more quickly. I'm going to go, be very aggressive, and you're likely to incur higher transition costs to protect against the physical costs. So if you think about the limited number of issuers that have credible science-based decarbonization targets, if you're very, very steep, you're going to reduce the investment universe drastically, and it may compromise the investment integrity of the portfolio. On the other side, that purple line, if you decarbonize too slowly, so you're behind that linear trajectory, you're going to have much higher physical risk from climate change. Emissions are staying elevated, and you're still necessitating high transition costs at some point in the future. And the reason that we show this is because we're telling you it's not an exact science. It's not a straight line to get there. And so what we want to do is measure and understand the implied temperature rise of the portfolio. We compare it to the Paris benchmark, and this helps us to calibrate the trade-off and keep track of a portfolio decarbonization progress. So it's just recognizing that there is compromise and there is not necessarily, just an easy path. And that's kind of what we're looking at here. So what do we suggest? 3 tools, essentially. The first is you can divest from assets that have the very worst carbon scores. You can engage with issuers, and you can invest in positive climate solutions. And I believe that Keith is kind of walk through some of those as we go forward. And it's important when we think about asset allocation, because if you look at asset allocation adjusted for climate trends, it tends to penalize the hotter developing countries. So then you have to ask yourself a question: should we stop investing in emerging markets altogether, or should we allocate more capital to them to help them transition faster? So this is just thinking about both inward and outward materiality. So if you avoid emerging markets outright, you might avoid elevated investment risk, such as rising sea levels or adverse weather, but you might also miss out on investment opportunities. So just these are things that investors, asset owners, need to think about as they're thinking about their portfolios. So when we think about sustainable investing, there's really a broad spectrum. This is how we bucket strategies. And there's a lot of questions, and these may come in terms of definitions around what everything means. I'm going to say for Schroders, everything is integrated at a base level. And then we can go from there. When you move forward, again, integrated, we're considering financially material ESG factors as a part of the full investment analysis. Sustainable, this is defining and measuring intended sustainable outcomes. So this might be focusing on companies that have made commitments, proven preparation to sustain business growth while combating pressures of regulation, changes in consumer needs, climate change. It could be a fund that says, I want to have a positive outcome on the world on any one of these specific measures. Thematic investing according to a chosen investment theme, such as health and wellness, climate change, again, climate, we're going to talk a lot about that. Impact investing, this is seeking to achieve a specific and immeasurable positive impact to society or the environment. This is important. It is intentional and it is measurable when we talk about impact investing. And each of these can play a role in decarbonizing a portfolio, depending on what the individual objectives of an investor are. As you move to the right on this chart, your strategies are becoming more objective-based and likely to include exclusions. They can be in the fixed income side or on the equity side. So if I were to look at this chart, a strategy on the fixed income side, something that we run, is sustainable core. The objective of this strategy is simply based on a proprietary score that we have. There are some individual exclusions in there, but to have a better score than the benchmark does, and also to be positive, meaning that the fund actually is providing positive externalities on the world. And then something, an example of something from a thematic standpoint might be something like climate change, where you're looking at how am I taking advantage from identifying it from a risk, as well as the opportunities that are associated with climate change. And in that type of strategy, you might see something where you're going to be limiting revenues that are associated with fossil fuels. So very, very clear objectives with that. Now, the one thing that I wanted to spend just a couple of minutes on when we look at this particular slide is when we go back to that slide I showed you a few minutes ago that looked at 80% or approximately 80% of emissions coming from 20% of the sectors. Utilities was a big circle. So what we're showing on this particular page are 3 companies. So company A, B, and C, and different within utilities, but different types of companies. So a renewable energy company, a company associated with electricity and gas, manufacturing and distributing electricity and gas, and then a residential solar and energy storage provider. And when you look at these, you're probably going to think to yourself, solar's got to be the best one up there. It has to be, right? Because it's solar. Well, what we do is we've actually built a proprietary metric that measures the externalities that a company puts out in the world. They might be good, they might be bad, and we have put it in, created it. It's all based on academic research, so it's not us saying morally that's good or bad. It's just saying academic research tells us X. And so that's what you see SustainX score. So if we go from company A, it has the best SustainX score. I don't think that's necessarily surprising because it's a renewable energy company. The key drivers are broken out by the E is environment, S is of course social, G is governance. You can see that it has a positive E that's driven by avoided emissions. And that's something from a renewable energy company that we would expect to see. It does, however, have some scope 1 and 3 carbon emissions. Those are negative, but the avoided emissions are higher. There's also some very positive aspects that are coming from a social aspect. And we think that's important when we talk about sustainability. It's a lot to do with the E, but it's not just the E. And then we show the MSCI ESG score, AAA, and the risk category is low. What I think is interesting is you kind of go from company A to B and C, is C, that solar company. There's some things about it that are very concerning. One of the things that really stands out why that score is so low, there are scope 3 carbon emissions that are driving that score down. Water use is driving that score down. And also the fact that it has unfair pay, and something that we really believe that we should be taking a look at. So the reason that I'm showing you this is that you don't need to outright necessarily exclude a full sector. You can find opportunities within a sector. So I'm going to stop there. I think I'm coming up right against my time, and open it up for any questions that anyone might have.
Thank you, Whitney. Do you want to unshare your screen so we can see the?
Oh, okay. Yep. Sorry about that. Okay.
Anyone else? Do we have questions from anyone who's attending? Mike Wood?
I
I'm not
have a
sure if I'll
question.
be able to. Okay.
Yeah, hi.
Come on.
Thanks. That was a ton of information. Great. I'm really excited that they're going to send the PowerPoint because I'm going to go back through and reread some of those pages with all that information on there. I've been kind of tracking on these issues for a little while, and my main question for you is actually for Schroders in general, this whole idea of singular materiality versus double materiality, and it sounds like Schroders looks at ESG strictly from a singular materiality lens. It doesn't get into the double material. It doesn't.
No,
So
it does. We
does.
do.
Okay.
We do.
Okay, great. I was just curious about that because that to me is I'm always wondering about ESG. Is ESG just a risk analysis, really, or is it also this idea that you're looking at risk but also impact?
It's both. To be honest, I was trying to keep my comments short, so I could have gone quite a bit longer.
You were great. Yeah,
when
I
was
could tell.
talking about emerging markets and why, like, I didn't want to get too far into the weeds on that, because there is an argument to be made that if you are investing in emerging markets from the double materiality standpoints, but I didn't want to get down that, didn't want to go down that rabbit hole. But
Sure.
Short answer is yes.
Okay.
And I think when you talk about sustainability, this is one of the, I'm going to say, challenges with it, particularly here in the US, is the lack of definitions around what sustainability means. So I showed you how we think about it. You start with just understanding what the risks are, because there are risks. Clearly, there are risks and there are opportunities. And then each of those additional categories, you end up with impact, where you don't have to give up return, but you can have a intentional and measurable. I mean, that is the key with impact, is we do need to be able to measure it. You can actually do something that's good for the world. Like, that's the objective of it. And I think that's something that it gets lost along the way for a lot of people around definition.
And so just one real quick, sorry, but so the scoring that you showed that at Schroders, when you do your assessment of the different companies and so forth, are you looking at the double materiality there? Is that built into that?
I'm going to have to step back, because that's one of 10 plus tools that we have. So that is just one lens through which we look. I was just trying to use that as an example. That particular score is interesting because it is based on academic research. So it literally is, it's just saying, like, if you look at tobacco has a cost, right? Like huge health costs that are associated with tobacco. So if I look at individual companies and I share out for those companies that have a specific, whatever X% of their revenue is associated with tobacco, and these are the health costs that are associated with tobacco, I can assign those costs back to a company. So essentially, I've kind of dumbed it down a little bit, but it's using over 1,000 different academic research reports. So it's not us saying smoking's bad for you. It's saying, well, no, smoking actually has a cost associated with it on the world. Right. That's what your SustainX score is. There's a number of other measures that we also are looking at, particularly if you want to start looking at impact. We have an impact scorecard that's actually going to kind of take it a step further.
Thank you. I'm sure there's a ton more information. Thank you very succinctly.
And we can share some of these links to the extent that you do want to learn more. There's a lot that we could share with you.
Thank you, Whitney.
Yeah, of course.
We'll definitely include, I'll be following up with Whitney and Keith, and we'll include resources in a follow-up email within the week. Are there other questions? I feel like maybe Teresa, were you trying to jump in with a question? Or maybe not. No? Okay. It's hard to read the Zoom room sometimes. I'm looking around. I have to, the way I have it set up. Oh, I should change my view and then I could see better. There we go. Okay. Great. I have a question, and I feel like this is a good one for you, Whitney, which is I am a very, very beginner investment person. I mean, I essentially just went to Keith, just full disclosure, Keith took our retirement money and took it out of fossil fuels. And we had a hard time finding anyone to do that. They were saying, oh, you won't make any money, yada, yada. And I went to Keith and I was like, will you do this? He said, yes. And we've done just fine. Thanks to Keith. But, at some point, so I don't know how, I get a little confused with all the scores and how it all works together, but just as an activist and an organizer around climate, as climate impacts increase, the choices that businesses and asset folks have are going to change. I mean, what is actually going to make money or be a safe investment is going to really change, and that could happen pretty quickly. So I guess my question for you is just, how is the industry or those folks, how are they tracking that? And I get the sense that you might be very on top of that question, but just like what's happening there and what is the thinking?
Well, you're absolutely right. If you were to look at why people should care about these issues, one, the regulation is going to happen here in the US, you know, whether it happens tomorrow or in, you know, several years, it's happening around the world, the number of regulations. So companies have to pay attention to these issues. The amount of capital that is getting reallocated, you know, even if you look at the Inflation Reduction Act, so the amount of money that is being directed to renewables is significant. I mean, it's massive windfalls to states that take advantage of this. So those are opportunities. And not only are those opportunities that you want to be able to capitalize on for yourself, but they also create risks if you're thinking about what stranded assets might be. So I think that anyone who is taking sustainability seriously is well aware of these issues. And you know, when you go to our website, you're going to go, oh my gosh, there's so much research. So we, like, our sustainability team at Schroders is 50 plus people, and it's dedicated to individuals like myself that kind of sit around the world, and then a research team. So we have a research team. They're broken down into 5 different themes. So we're looking at natural capital. We're looking at biodiversity. We actually had a group, you know, talking about the indigenous land. A group of us were at COP15 in Montreal earlier, I should say late last year. So I mean, these are things that we're looking at: natural capital, biodiversity, human capital, human rights. I'm trying to think, what did I miss off the top of my head? But essentially research, and that research is driving some of the tools that we're building so that we understand how that affects portfolios. It's driving the questions that our investors are asking when they're engaging with their companies. And it's driving how we integrate portfolios. So we think about integration. As I said, all of our strategies, the investment capabilities that we're running need to be investment integrated. They need to be addressing these questions. So I think anyone who is taking sustainability seriously, that they're looking at these things. And I would say asset managers are well aware of what these risks are. I think the big key is, can you show somebody what you're doing? And that comes to reporting. And that's also something that we've spent a lot of time on when we built SustainX. SustainX was built more than 5 years ago. And it's kind of, we continue to tweak our models, but we're using that for a lot of our reporting. If you think about the reporting that's required in Europe, you know, we built it because we thought it made us better investors, and it's great because it now also works as, you know, a reporting mechanism for us. So I think that asset managers are well aware of what these issues are, and you want to be able to identify how they help investors like yourself.
Thank you. Yes, as my grandpa always said, you can't eat money. He grew up in the Depression, and he was like, it's nice to have if you have to buy groceries, but you can't eat money. So I was curious about that and how the industry is going to respond as things get more intense. Thank you so much, Whitney.
I will say there's a lot of politics around it right now. You just have to fundamentally get back to, are you looking at financially material factors? And if you want to do more, and you want to have impact, and you say, I want this objective, that's okay too. But fundamentally, you're looking at financially material factors.
Winona, can I just?
Oh yeah, go ahead, Mike.
That was my question about the double materiality. I think because I think that that's where it all comes to a head. Where, and I just put a question in the chat. You know, some legislatures are there's legislation being introduced that's prohibiting fund managers from even considering ESG because they're taking it a step farther than I think what you're saying. You know, you're saying it can be nothing more than a risk analysis of material factors that could be impacting companies. It doesn't have to be anything more than that, but the politics are that they've taken it farther, it becoming this sort of the anti-woke capitalism and all these things you sort of hear now these days. And I'm just curious, if you don't mind, Winona, just I'll stop if you could do, but I'd love to hear what you and Keith, I know you're going to come on and talk to what you both think about how it's going to play out. It's just crystal ball sort of stuff.
I'll be very brief. I think we're going to hear a lot about it for the next couple of years. I think that from our standpoint, the more transparency that we get around definitions, the better for all investors, because it's really hard because there's not one definition for anyone. I mean, everyone on this call could actually have a little bit of a different idea as to what it means, and that makes it really hard. So I think the objective of the SEC with respect to providing some clarity around, some definitions, I think that's definitely positive. I think we need more education, but I think that it's still going to get a lot of press, in my opinion, over the next couple of years. And I think that if we just continue to try to say we're doing it, like exactly what I said, it's about investing. It's about why we think that these factors help to make a better investment decision. Fundamentally, if you choose to do more, you can choose to do more. And we have clients that want to do more, and then we have clients that don't.
Yeah, and I'll just jump in real quick, Mike. And it's funny, a lot of this conversation is a lot of what I've prepared tonight. So I feel like I'm going to be repeating myself a little bit, but I would just say the movement is real. And I think Montana, and especially a lot of my clients here in Missoula, have done an amazing job with, the positivity around ESG and decarbonizing portfolios. And I can't speak to, New York and a bunch of other spots because I don't have clients over there, but I would say people are doing their part here. And I don't, in my world, hear very little negativity about it in Montana. So that's exciting.
Keith, I would say that's your cue. Thank you, Whitney, for your time tonight. I know you may hop off because you're on the East Coast, and we really appreciate you joining us.
No, thank you. I appreciate the time, and any questions, I'm happy to follow up with Keith and Winona. So thank you very much for joining us tonight.
Thanks, Whitney.
Thank you.
Okay, Keith, take it away.
Awesome. Thank you so much. So we brought Whitney on really to give the institutional approach. Where I come in is as a local financial advisor here in Missoula, and kind of how I look into the ESG movement and how I can try to make a difference in my community. So I'm going to be bouncing around to a lot of different stuff, but I want to just kind of share how, just like Whitney said, how you can do more. And well, here, I'll just kind of jump into my slides and we'll kind of go through it. A little bit about myself, which nobody really even needs to know that much, but I am an Edward Jones financial advisor. I deal with investing. I've been more of a mental health therapist this last year than anything else. But I really try to educate clients out there because, to me, just like Winona and what she's doing with her organization is I want to, leave the world a better place than where it is right now. And if I can make a difference just with putting investments into low carbon or no fossil fuels, I'm trying to do my part. Okay. Just like Whitney said, there is a big problem out there when it comes to investing, especially on a local level. And this was touched on a little bit, but there is no central ESG tracking platform out there for anyone. She talked about at Schroders, they've got their own Sustain X score, right? Every investment asset manager has their own score. I go out to there's MSCI, there's Morningstar, and I'll jump over real quick here just to Morningstar. It's a platform, it's a research portal for investments, and I subscribe to it every month. But if I just go in here and I'm looking at insights, I'm looking at stocks, there's nothing out here that says ESG, right? You got to dive a little deeper. So if I just, for example, I don't know, let's pick a stock. I know most people on here haven't probably heard of Farfetch, but it's basically an online platform for the uber rich to trade their Louis Vuitton purses for each other. And that's basically what this stock is. But if I go into it a little bit more, I can scroll down deep into this thing and I can click on their sustainability. So Morningstar has their own sustainability score and they call it their ESG score and they give them an 18.58. Okay. Well, what makes up that 18.58, right? It's unique to Morningstar, just like Sustain X is unique to Schroders, but it does give us a little insight at what some of their issues are, right? Data privacy and security is an issue for them, which goes against their sustainability score. They have low incidence, which is great, but this is just one little aspect that we have to look at to try to figure out, well, is Farfetch really a ESG company? Are they sustainable? What about their carbon emissions? All of that kind of stuff, you've got to dive a lot deeper, which is what I think, in my opinion, makes my job pretty difficult in all reality. Well, I'll just kind of jump in here too. I do my own research, okay? And you can see right here, it's a spreadsheet, right? And I look into mutual funds. I look into what are called ETFs. We'll get into this, but there's a great website out there called fossilfreefunds.org. But, is deforestation important to them? How do they deal with gender equality? Do they have firearms involved? Are they into prisons? Do they do tobacco? Not only that, as an investment advisor, ultimately, I want to be as green as I possibly can, but ultimately, I want to make my clients money too, right? So then I look at, what are the year-to-date returns? In 2020, 2021, what's their Morningstar environmental score? What do they do on social? It's kind of a lot like that Sustain X was with the different categories. So I dive a whole lot deeper into the investments other than just, hey, they come up on Morningstar as, fossil funds free, right? I try to take it a whole nother level by diving a lot deeper, okay? And I'll get into this a little bit more too, okay? The other thing that we talked about this a little bit from the institutional standpoint is what is the ESG initiatives for the company? Right? Are they more concerned? And she went over scope 1, scope 2, scope 3. So I don't have to go into that a little bit, but it's the same for individuals. Certain individuals sit in front of me and the first question I'll ask is, what's most important to you? Is it being no fossil fuels? Is gender equality more important? Is being invested in prisons more important? And then my job really begins on trying to dive deeper into that. The other issue that we got out there right now from a personal standpoint is how to track it, right? Now, Schroders tracks it, but they have their own tracking, right? There is no public information out there. What is ESG to Keith Fitchner might be different than what ESG is to Mike Wood, right? Or Fran or Teresa, whatever the case is. There's no uniform tracking out there. Okay, the only solutions that I can really come up with is hire a professional that cares. And that doesn't have to be Keith Fitchner at Edward Jones, right? But any financial advisor you're dealing with, if you really want to make a difference, ask questions, right? What's your investment philosophy? Do you believe in utilizing fossil fuels as part of your investment portfolio? The other thing is do your own research. Everybody on here has the internet. Al Gore invented it 25 years ago, but, there's a lot of information out there, right? And I had a client that, claimed to be very ESG, and they brought up a company, Waste Management, right? Which, what do they do, right? Landfills, right? That's about as hurtful to the planet as possible at this point. But when you dive a little deeper, what are they doing as an organization or a company to kind of make themselves more ESG? And right online, they've opened 43 recycling plants in the last year, and they've purchased 10,000 electric garbage trucks. So you tell me, are they ESG? Are they not? Right? To me, they're still not, but at least they're doing a little bit to get themselves more green, so to speak, right? So this is the dilemma I have as a financial advisor, because the tools really aren't out there for me to just be able to actually pull up and say, you know, who's ESG, who's not, right? But it's really important to me, so I try to dive deeper, okay? We already talked about greenwashing. Most people know what greenwashing is, but it's something I'm very cognizant of when I'm researching investments, right? It's basically companies out there putting PR campaigns out there to say they're environmentally friendly, when the truth is really hard to find out there. You know, example I came across is PNP Paribas, which is a bank, okay? But when you dive deeper, they claim out there they're really eco-friendly and green. Well, who are they backed by? They're backed by Bank of the West. And Bank of the West in the last 6 months have put out 2 different PR campaigns. One to say, hey, we're exiting from coal, and we're not going to invest anymore in Arctic or Amazon oil and gas drilling. But when you really look into Bank of the West, they've actually increased their fossil fuel developments over the last 6 to 12 months. Okay, the other thing that I always say to people is, I do say temper your expectations, okay? Is there a perfect company out there? I don't believe there is. There's a lot that are doing a lot of parts, but you know, Whitney talked a little bit about solar, right? How do you produce the solar panels? You got to use fossil fuels to produce those solar panels. So, but the solar panels are creating energy efficiency. So it's this cycle, right, that we've got to go through when we're really looking at what's important to a client. You know, solar, I think, is great, right? And it's a wave of the future, right? But we got to do a little bit of fossil fuel usage now to get to the end result. Okay. Another site, and I mentioned this earlier, fossilfreefunds.org. Okay, Schroders is actually a branch, an asset manager for Hartford. Okay, for those that don't know. So I use this site a lot. And basically what I can do is I'll go out there. I just found Hartford Global Impact as a mutual fund. Okay, and I'll just kind of tell you guys a little bit about how I look at it. Okay, HDXAX. Okay, HDXAX. Hartford Global Impact. I can put in any mutual fund in here and it'll give me a fossil-free funds score. And I really like it because it makes it simple, okay? It's like a grading system. We're all back in school. You either get an A, a B, a C, a D, or an F, okay? They get an A because they have no fossil fuel holdings, okay? Which I think is great, right? But I don't just stop there, okay? What I try to do is dive even more deeper into this, okay? So if you really go down, they do a great job. They're not so great at gender equality, okay? It's an old boys club basically here at this mutual fund. But they've got no firearms. They don't deal in prisons, no military weapons, no tobacco. You can dive very deep into researching investments when it comes to this. So then what I try to do is I try to go even a little bit deeper out there in terms of looking at companies, okay? So there's information out on the web. I call them fact sheets. Okay, Hartford puts this out, which talks about, this is Hartford Global Impact Fund, okay? They lost 22% last year for the companies they invested in, okay? Not a great fund performing last year. It's only been around about 5 years and it's still averaged a 5% return. Okay, so it's something I have to consider whether or not I recommend this investment. But I really go and try to dive a little bit deeper into the holdings. Okay, what are the stocks or the companies involved in Hartford Global Impact? Okay, Boston Scientific, Globe Life, just for whatever reason, hit me like, I don't know anything about Globe Life. What is Globe Life? You know, how can I dig deeper into Globe Life? Okay, so basically I went out and I just searched Globe Life on the web. Okay, and something I found is their internal environmental, social, and governance report. Okay, if a company has this out here, this is their take, right? This is, again, there's no uniform tracking system, nothing out there that's uniform in the investment world. But we'll look at what they're doing to make a difference, okay? And I summarized it in here. They've come out and they said they have reduced greenhouse emissions by 5.5% per employee. How have they done that? Okay, when you dig into the weeds, they have one major location. They planted 1,800 trees on the property in 2018 or in 2019. All their windows are double paned and tinted to keep the energy efficiency inside. Every plumbing fixture is motion censored to not waste more water and recycled in there. 55% of all their lighting is LED. Their goal is to be 100% by 2025. And Globe Life is an insurance company. Okay, they do life insurance. So this is probably the thing that struck me most. What is a life insurance company? It's all paper. That's basically what it is, right? But they've recycled 33 tons of paper, cardboard, and other items. This was in 2021. Okay, they've also diverted 32% of waste from landfills to local recycling facilities. So they're doing a lot to make themselves a little bit more ESG. Okay, but are they perfect? Probably not, but this is a conversation piece I have with my clients. Okay, so what's my process? As a financial advisor, and I'm meeting with someone locally, what's my process? Okay, I've already kind of touched on some of my process, whether you're starting from scratch or in its existing portfolio. The first thing I always do is I use fossilfreefunds.org because it's been the best site I've found to give their fossil-free funds score. Okay, then once I find certain investments, if it's an existing portfolio, I'll put in the mutual fund and then I'll dig deeper into the holdings, just like I did on the Hartford Fund, and I found Globe Life, for example. Okay, this is also the hard part about my job, is it's ever changing, right? Most mutual funds are actively managed, so they're bringing stocks in and out of them all the time. So I have to keep up on that, right? I have to cross-reference what new companies they're investing in, you know, and you know, there's certain funds in Winona's portfolio that I cross-referenced recently, and they went from an A to a C on fossil fuel. So then I'm like, all right, we got to swap it out, right? Let's find some other good ones. So it's an ever constant battle for me. Then I review the financials of the company. Okay, are they profitable? You know, what's their earnings per share? What's the price to earnings ratio? Are they, you know, for every dollar they bring in, are they spending 10? You know, and what are they spending it on? Are they spending it to become more ESG? Are they spending it to build other facilities? You know, hire people? And then I look at, are they undervalued or overvalued based off of their financials? So it's a whole process I got to go through when I'm dealing with investments. Okay. Gonna switch gears a little bit because I know this question was asked of me recently, but I touched on the BNP Paribas and the Bank of the West. But a lot of people ask me too, even though I deal mainly with investments, when it comes to a credit card, you know, what cards are out there are eco-friendly? Now there's two of them I just mentioned here. There's a bunch more out there, but these two struck me recently. There's one called Future Card, Visa, which I think is a really cool card. They give more cash back on stuff to be more efficient. Public transport, electric charging, electric cars, bikes, scooters. The other thing I really like about them is there's no physical card. So there's no more plastic in the world. Okay, it's all done on your phone via Apple Pay, stuff like that, which I think is a really cool credit card out there. The other one is Aspiration Zero. And I really look at what bank is backing that. It's the most important function of that card. But they claim they're offsetting their carbon footprint by planting more saplings than any other credit card out there. But they're backed by Beneficial State Bank, okay, which is fossil-free certified. Okay, so that is another card I would recommend out there if that's something that's really important to you. And then the last slide, I really want to just summarize, I guess, why I'm here tonight and why I do what I do. And I wrote this, and it's kind of a mantra that I've been kind of trying to live by from a financial planning and an investment perspective as an individual. But efficiencies will come from proactively transforming how we do business. Okay, it takes a village, but the village starts with an individual. If you do your part, just like I do my part, collectively we can make a change. And I think that's just an important mantra that I live by in decarbonizing people's investments and their money. So with that said, I will open it up to questions too. I wanted to keep it as short and sweet as possible as well.
Thank you so much, Keith. I would love to hear if there are questions from anyone who's still on the call. Feel free to just jump in.
I just wanted to thank, can you hear me?
Yes.
I just wanted to thank Keith for the answer to my question on credit cards. I've been scratching my head about that for years. I hate to leave Capital One because they are very efficient, but I'm going to make the jump based on what you've given us. So thank you for that. That was very helpful. And the other thing is being on this call allows me to see my sister who lives in Missouri. Hi, Teresa.
Whoa, my lights just went out. That was weird. Maybe I have to move. I'm in the library.
Yeah.
It's those efficient lights that turn off when you're not moving. That was
exactly.
Yeah.
Exactly. No,
Apparently,
Fran,
I
it's
was very
something I've
still.
been looking into quite a bit lately, even though it's it's not part of my business specifically, but it's still important, right? And there's multiple other ones out there. I mean, on a worst case, I would say deal with a credit union, because most credit unions are as ESG friendly as they can be. It's the national banks, it's the Bank of America's, the Capital Ones, the Wells Fargos that are backing fossil fuels.
But it took me a while to realize that really is part of the whole investment operation. Is anytime you have a credit card that represents the support of the underlying bank and whatever they support. So now that I've got that in mind, I'm ready to switch. Thank you.
Yeah, you bet.
So
Yeah,
great.
no,
Go ahead.
it would be neat. I don't know if you guys have already done this. Apologize if I missed it, but it'd be neat to have a session just thinking about that, about looking at the banks, and because really that's sort of the not enough people are paying attention to. That's what the big industries really are dependent upon. It's all leverage financing, it's all loan financing, and so really kind of figuring out where are we banking and what are we supporting through the banks that we participate with. But I do have a question for Keith, if that's okay. And apologies if, I've kind of been obsessing a little bit about this, but when you're out there on your own and you're just sort of picking up pieces, this has been so great just listening to you and to Whitney. And I'm here in Missoula. I'm going to follow up with you, Keith. I definitely want to continue a conversation with you. Both you and Whitney talked about one of the biggest challenges being that there isn't a consistent rating system. But I am hearing some glimmers of hope that You know, SASB is, you know, the rules under SASB, the sustainable, what is it? The
Yeah,
SASB is
SASB.
linking up with some larger companies, kind of all, there's a confluence happening with the ratings, and it's in alignment with, I think, what's happening in Europe, which
yes.
is really important. So can you speak to that a little bit and what you know of the timeline?
Through Edward Jones analysts and some information that's passed along, it's coming, but it's slow, right?
Yeah.
I mean, I wish I had a timeline for you. I have no idea. I
Yeah.
hear the same stuff. I'm out on the news articles all the time, hearing the same stuff.
Yeah.
And Europe is driving it. It really is.
Yep.
And, you know, the uniformity here in the US, because there is so much money involved in the stock market.
Yeah.
That it's becoming more and more important. But I wish I had a better
Yeah.
answer.
No,
I hear the same
I'm
stuff.
just curious. Okay.
You know, the banking industry, they're being regulated more and more and making ESG initiatives a must. And they're fighting it. They're all
Yeah.
fighting it because it's a lot of money.
Yeah.
That they have to put out there to become ESG. So that initiative has been really slow, but that would be a great one to dive into, because there's more greenwashing in banks than there is.
Absolutely. And then lastly, I'll just ask one other quick question to see what your insights were on, I know the SEC rule is coming. I'm hearing about June now, but
Yep.
I'm also hearing that they're backing off, especially on the scope 3 stuff. They might be just doing a scope 1 and 2. Are you hearing the same thing?
That's exactly what I'm hearing too.
Yeah.
And it keeps getting pushed.
Yeah.
I honestly don't think June it's going to happen. I just
Yeah.
don't. It's kind of like the student loan forgiveness, right? It keeps getting pushed off and pushed off. It'll be
Right.
the same thing. It
Right.
really will. I mean,
Yeah.
I know we're pushing scope 3 type stuff out there, but again, it's all about the dollar. It
Yeah,
is
that's right.
all about how much money.
Yeah.
I hope. I really do. I'm just trying to
Yeah.
do my part locally at this point.
Yeah. Love it too. By the way, that your philosophy is fantastic, and just thank you for being on. Yeah.
Yeah, you bet, Mike.
Thank you. Yeah.
Any last questions tonight? I mean, you can certainly shoot me an email if you get off the call tonight and you think of a question, send it my way. I can check in with Keith and Whitney and see if they have an answer. And we'll do our best to follow up with as much information as possible within the next week. Go ahead.
Without, at the risk of being rude and talking too much, I apologize, but just wanted to share with everybody else also, US SIF and As You Sow are 2 resources that are available. I could put those in the chat. I don't know if you've talked about these already. Yeah, those are great resources. I know As You Sow uses the fossil free fund tool as well, but they're particularly good with educating people as shareholders about your rights as a shareholder, things that getting involved with proxy voting and things like that to affect company policies. They're really good at that stuff. So that's As You Sow. And then US SIF, so USSIF is a fantastic organization for all things sustainable investing. They even have classes you can take for free that are basic classes that kind of give you a baseline.
Thank you.
Yeah.
Great.
Yeah.
That's great. Thank you.
Yeah,
Appreciate
cheers.
that. Okay. Anyone else? Keith, I'll just ask the question I always ask. How hard is it to move your money out of fossil fuels? I know that Whitney talked about like these different curves, those people who want to just go dramatic, which was our family. We're just like, take it all out.
Right.
deep decarbonization of our portfolio now, please. And try to align with some of the other values that you touched on. But how hard is it? And what do you want to leave people with tonight?
Yeah, I don't think it is very hard. And that's where Whitney and I will disagree. I am, let's get out now. It's not that hard. It really is. It depends on the type of account that you have, a brokerage account versus an IRA, for example. An IRA, it's simple, it's easy, it's immediate. A brokerage account, you got to be conscious of what gains and losses you have on certain investments and whether you can exchange it potentially into another same fund family investment that's more ESG. But I mean, within an hour or two, we can probably do it.
Great. Well, that was my experience with you, Keith. And I'm not here to give Keith a commercial. Keith is just a great guy. He moved our money out of fossil fuels, and I don't get a kickback from this for anything, or he doesn't. He volunteered to come and support our organization and Families for a Livable Climate, in helping families that have investments make a really big impact. It's a bigger impact than changing your light bulbs, which you should do, but moving your, your investments, your retirement, your banking, whatever money assets you have out of fossil fuels and into better companies seems like a very impactful thing families can make. And as Keith said, out of our workshops, he's moved something like $3 to $4 million. And so for a small organization that has run 4 4-hour workshops on decarbonizing your money, I would say that is a big impact, and I'm proud of it. And I'm happy to have Keith's expertise and the other folks he brings along. So thank you again, Keith, for showing up and volunteering your time.
Always. Thank you for having me.
All right, everyone, it's late. I think I get kicked out of the library in like 5 minutes, and my family's probably wondering where I am. So I hope everyone has a great night. Thanks for showing up, and I hope this was useful. And please, if you we'll follow up, like I said, and if you have feedback or have other questions, please reach out.
Thank you, Winona.
Yeah.
Yes, thank you, Winona. Thanks for doing this. I'm sorry I'm so late to the game. You've been doing this for a while. I just learned that you guys have been holding these sessions, but I'm excited that you're doing this, and I'm going to follow up with you, Winona, as well.
Great. Great.
Yeah, for sure.
That would
Thank
be
you.
great.
And Keith,
Okay,
thank you.
have a great night. I'm going to stop recording.
Bye.